Welcome everyone to FX Street. It's 8:31 a.m. Eastern, September 20th, 2011. Welcome back, one and all. Great you could join us. Ed's the best, by the way. We used to work together about 1,000 years ago. My name is Adam Rosen, by the way. Very happy you could join us. You should be able to see the charts. We're going to talk about one of my favorite topics, which is October. Excellent. I'm glad it's excellent. Good. We have 4 very active months of the year, 4 very active periods of trading of the year. Those revolve around the corporate earnings that are released January, April, July, and October. July is known to be quite active, and October is known to be quite active and also at times quite negative. And my personal prediction for this October, I think it's going to be very, very interesting. And I'm sorry to say, my personal predictions, I think, it's going to be kind of negative. But we'll get to that. What we're looking at here, and I think this October is going to be by far one of the more interesting months of the year. We're looking at an Aussie yen chart. We could look at really any currency pair, dollar Swissy, Aussie yen, dollar yen, whatever it may be. We're going to see basically the same picture. Now, I drew vertical lines on July 1st and July 31st, marking off the period, the month of July. Now, we also plotted the Bollinger Bands. The Bollinger Bands is a 20 simple moving average, and the upper and lower bands are that simple moving average, extended 2 standard deviations above and below the simple moving average. Okay. Now, one of the great things about the Bollinger Bands is it gives us the ability to measure the amount of volatility. Now, typically, the most volatile months of the year in the stock market and certainly translates over into the foreign exchange market is July and October. For some reason or another, July and October tend to be the most active. If you look at the Bollinger Bands, in July, they were actually quite narrow. And I talk about July because I think the same phenomenon that happened in July, we're going to see again in October. What happened in July? The Bollinger Bands were very close together, despite the fact that corporate earnings were released. There's actually a lot of news that was released in the month of July. Normally, we would have expected the month of July to be quite volatile. It was not. The reason being, if you recall, that the entire world was basically watching and waiting for the U.S. debt ceiling crisis to abate. The Democrats, Republicans, they were arguing nonstop. Should we raise the debt ceiling? Of course we should, or we should not. Well, if we do, where are we going to cut the spending from? We don't know. That decision to raise the debt ceiling was finally made in the end of July, and then shortly after, that ratings company by the name of S&P, Standard & Poor's, came out and said, you know what? We don't have a lot of confidence in the U.S. political system that they're going to be able to come to some sort of decision as far as where to come up with the spending cuts to raise the debt ceiling. And they lowered the credit rating. Well, as a result, the Dow Jones Special Average and a lot of currency pairs reacted very, very sharply to the downside, including the Aussie yen. This big spillover to the downside happened in August. That was not normal. Normally during the month of July, and if you look at the charts in the past, the month of July is the volatile month of that session, of that quarter, so to speak. August is supposed to be quiet. It was the opposite. My personal theory is that, well, corporate earnings were released. There was a lot of news was released. Central banks met, CPI, non-farm payrolls, a lot of numbers that were released. But if you ask the average trader out there or the average investor, well, what are you going to do? You know, what kind of position are we going to take? A lot of people would say, you know, I'm holding on. I'm not going to take a big position because I want to see the outcome of that debt ceiling debate. And all of that waiting formed or created a lot of tension in the markets. You know, when news is released, some traders want to buy, some traders want to sell, and if there's a greater amount of traders that want to buy or sell, whatever it may be, it creates tension. It's like pulling back or compressing a spring or pulling back a rubber band. And we're waiting for that catalyst, that one reason that wakes the market up, that sends us into a trend. That catalyst in the month of August was the S&P downgrade. which most of us, including myself, I didn't expect it to happen so soon. I thought that maybe it was going to happen, later on down the road. Didn't expect it to happen the first week of August. Well, that tension was finally released. The tension was to the downside. There was a lot of corporate earnings. Again, a lot of economic data. But the overwhelming, theme of that period of time was the S&P downgrade and the fact that not only S&P, but, a lot of us really do not have a lot of confidence in the political climate that we're in, that the Democrats and Republicans, whatever you want to call it, that they're going to be able to come to some sort of resolution, that they're going to be able to come to some sort of agreement, say, okay, you know what, we have to cut spending somewhere, or we have to raise revenue somewhere, or we have to do a little bit of both in order to come up with the extra money to raise the debt ceiling. The reason I bring this up is because I think the same thing is going to happen in October. October is another corporate earnings season. January, April, July, and October. I don't know. I think that October we're going to see a good amount of volatility, but, excuse me, but I think we're going to run into the same thing because remember, all of that political infighting that took place in July that led to that big sell-off in August, that was just to come to the agreement to raise the debt ceiling. Now, where are we going to get the spending cuts from? Well, they formed this committee. It's called the Super Committee. It's made up by Democrats and Republicans, and they have to meet. And I think they have a deadline somewhere before Thanksgiving, because obviously Congress, the government, federal government goes on break. In October, they actually have to come to a decision. Where are we going to come up with the spending cuts? Are we going to raise taxes or cut taxes? Are we going to increase spending or reduce spending? The really big decision hasn't happened yet. The really big mess, I should say, hasn't happened yet. That's going to come in October. And if you want to put a little bit of an extra complication to the matter, if you want to complicate things even more, think of the fact that we're getting closer to an election cycle. So now the Democrats are going to become super Democrats and the Republicans are going to become super Republicans. All of these politicians are really going to fall back on their party lines. I think it's going to become even more difficult for the right and the left to come together to make a decision when a lot of them are either campaigning for re-election or campaigning for some sort of election or supporting someone that is campaigning for an election. I think this October is going to be a really, really big mess, and politically speaking. And I think that's why there is going to be, I would say, a negative tone. And we can say the same thing it holds true in the Eurozone as well. We look at the Greek possibility of a default in Greece. Well, the stronger economies like Germany and France, they're expected to come up with a lot of the capital to support a possible stimulus plan. But Germany and France have come forward, especially Germany, and said, listen, we're happy to help, but we want to see that there are certain fiscal measures that will be taking place, that will be enacted, meaning that, okay, we'll support a stimulus plan to prevent Greece from defaulting, but the fact of the matter is we don't want to throw money into an endless pit of debt, an endless pit of there's a higher debt to GDP ratio of more than 100%, that we want to contribute money to that cause only if we think it's going to do some good. So far, that's not taking place. And unfortunately, I don't really like to pay a lot of attention, put a lot of credence into politics, but the fact of the matter is, it's going to play. It already has begun to play a very, very big role. And I think that's why October, especially when we have this deadline that in the U.S. the federal government goes on break around Thanksgiving, that super committee has to come together and make a decision. There are a lot of issues that we're going to have to address in the month of October, and I'm going to try to cover as many as I can here. But I think that is the overwhelming theme. I think that maybe the market might not be as volatile as we would expect. I mean, who knows? Maybe the market will be very volatile. But if you think about it this way, the volatility that we expected to see in July was put off until August. August, we expected to have very quiet trading months. So in between the first two lines, that's July. The next two lines, that's August, August 1st to August 31st. We expected that to be quiet months, this period of time to be quiet months. This so far has been active. We know this because take a look at the width of the lower Bollinger Band to the upper Bollinger Band. In July, and this is just the Aussie, and I just picked currency pair at random. I know the Aussie end tracks pretty closely with equity markets. At any rate, the lower band, 83.40, the upper band, 87.90, and we're looking at about a 400 pip spread from lower band to upper band. That's in July. Not very much. In August, when we expect things to be quiet, we actually had a lot of volatility. The lower band, 76.80, the upper band at its high of 88, about a 1,200 pip. We went from a spread of 400 pip difference to 1,200 pip difference. Now, well, today we look at the lower band, 7,800, the upper band, 83, about a 500 pip difference. Point being is that in July, when we expected things to be active, they were not. That volatility was pushed forward or delayed until August. Well, August, according to the natural market cycle, we expected things to be quiet. They were active. That quiet markets, I think, were pushed forward until now. That's why markets are so slow now. Well, eventually, we expect things to become active again. Normally, we would expect that to take place in October, but my suspicion is it may be pushed forward maybe to the end of October. I have a lot of different things to talk about. I want to really quickly take a look at some of the stories today because it all kind of goes together. Earlier today, Reserve Bank of Australia, Australia's central bank, released the minutes from their latest meeting. Australia is a really interesting story because typically we look to Australia as a source of growth, as a source of strength, as a source of confidence. We do have higher interest rates, high commodity prices certainly have benefited the Aussie currency. There's a growing anticipation now, though, that, and the unemployment numbers have gone up in Australia, the inflation numbers certainly haven't helped. There's a growing anticipation that the Reserve Bank of Australia will not raise interest rates. And in fact, I believe it's Goldman Sachs, the Australia division of Goldman Sachs, actually predicts that the RBA, Reserve Bank of Australia, may even cut rates as many as 2 times before the end of the year. This is a big change. The minutes, just to read an excerpt, were released earlier today. It says Australia's central bank is well positioned to respond to global and domestic economic risks or the threat of an acceleration of inflation, according to the minutes of the September 6th meeting, where, again, it kept interest rates unchanged as expected. Quote, a key question for members was the extent to which recent global and domestic developments would reduce capacity pressures in the economy and in due course help to contain inflation. Again, that's from the minutes of the RBA. They said members considered that the current setting of monetary policy left the board well placed to respond to evolving global and domestic economic conditions. It's actually a little bit of a more positive spin than we would expect coming from the RBA. But nevertheless, we would normally expect to see a lot of confidence. You know, when we look to the Eurozone and the U.S., we expect to see bleak news. We typically expect to see really confident news or confident Fed speak coming out of Australia. It's been less than confident lately. Man, these minutes are a little bit better, but not really what we'd like to see. Now, next on the list of news earlier today, Italy's credit rating, and this goes right into the story with Greece. Earlier today, Italy's credit rating was cut by Standard & Poor's, the country's first downgrade in 5 years, as Greece's worsening fiscal crisis fans concerns of contagion will engulf countries such as Spain and Italy. S&P lowered its rating last night from A to A from A+, saying weak economic growth, a fragile government, and rising borrowing costs will make it difficult to reduce Europe's second biggest debt. And the yield on the 10-year bonds rose 8 basis points. Now, talk about the yields. I hope you can see this. I'm going to take a picture of this. This is a really neat little application from Bloomberg where you're able to, I hope you can see this. You should see, a screen with a bunch of different quotes on it. It's a free application from Bloomberg.com. I threw in a number of different 10-year bonds onto this application. Now, I like to compare 10-year bonds from Greece and Italy and the U.S. because it's more or less an equal comparison, so to speak. Now, from the top on down, well, the first quote's Bank of America stock. I like to watch that because I kind of think really bad things are going to happen in that stock, more so than already has happened. But here's the situation. Okay, I like to look at the percent change of the bonds. Now, when stocks usually go down, the bond yield will go down. When stocks go up, the bond yield will go up. Today is not really a good example because stock futures are indicating higher. But yesterday, it was very, very clear. Because when the stock futures would go down, we'd expect the yields to go down. But in the case of Italy and Greece, the yields were actually going up. You see, the bond market has to compete with the stock market. When stocks go up, the bond market says, hey, nobody wants to buy bonds anymore. We have to offer a little bit of a higher yield. So yield goes up, but then the bond price goes down. Because if you think about it this way, if we have to pay the investors a little bit higher yield, the inherent value of the bond is actually a little bit less. So normally we would expect the yields to go up when the stock market goes up and yields go down when the stocks go down. But there's another dynamic, because when there is an increased risk of a default, that means there's more risk. That means that the bond market has to pay us a higher yield in order to take that risk. If I were to sell you a Greek bond, you would say, hey, I don't want to buy a Greek bond. There's a very good chance I might not get my money back. So I'll say, okay, well, I understand. I'm going to offer you a little bit of a higher yield to compensate you for that risk. The same way that, if I'm a high risk borrower, and I go to capital and credit cards, they're going to say, fine, we'll give you a credit card, but we're going to charge you a higher interest rate because, the past couple of credit cards we noticed you didn't pay them back. It's basically the same dynamic. So you'll notice, especially when the stock market goes down, we would expect to see yields go down. Certain countries where there's risk, you'll see the yields actually going up. Now, from the top on down, we see the GAC, CG. I'm not going to read, obviously the whole symbol, but the first symbol is the Aussie. GAC is Aussie. That's the Australian 10-year bond. The bond yield is basically flat. 4.15% is the yield. Typically, you'll see that yield move in the same direction as the stock market, meaning if the stocks go up, the yield will go up. When stocks go down, the yield will go down, because there's a relatively very small risk that Australia's going to default on their bonds. The next one below that, if I'm not mistaken, is Italy. The Italian bonds are up 1%. Now, we can compare, some of the yields are up, some of the yields are down. The Italian bonds are actually up, some of the highest, the biggest percentage move to the upside because of the credit rating downgrade today. You see, the real fear is that if Greece is allowed to default, or if the IMF, the International Monetary Fund, European Central Bank, if they're not able to prevent Greece from defaulting, what's to say that Italy may not be next, or may be next? What's to say that Spain or Portugal or Ireland may not be next? If you want to look to see which countries are most likely to default, or at least if the bond market faces an increased chance, two things you can look at: the yields, and also, if you do a little background homework, the debt to GDP ratio. That if there's a higher amount of debt to GDP, that the country has more debt than they're actually taking in every single year, that's not good. So that's why the Italian bond yields are up. The next one is Canada. They're up 0.91%. But again, today's not a good example because stock index futures are up as well. So we would normally expect that to be up as well. Germany, 1.8%. And by the way, compare the yields themselves. In Australia, we have 4.15%. In Italy, we have 5.65%. Why is Italy offering us a higher yield than Australia? Because there's a higher amount of risk. Canada's next, low risk, 2.2%. Germany, even lower risk, 1.8%. The next one, Greece. You want to buy some Greek bonds? 23% yield. Now, they're down a little bit today, but the fact of the matter is they're offering a 23% yield because there's much higher risk that they're actually in default. The next one below that, and I have a lot else to talk about, but I just want to really cover this really quickly. Ireland, 8.6%. Yields are down a little bit. Below that, we have, that's Japan, just about 1% yield. New Zealand, 4.4%. Spain at 5.3%. Portugal, 11.64%. And below that, the UK, 2.4%. And then way on down, the US at 1.97%. So it's very simple to, if we trade, for example, the euro currency, and we know the most dominant, I don't think I have France here, I should. The strongest or most dominant countries in the Eurozone are Germany, France, Ireland, Greece, Portugal, Spain. Did I say Italy? Italy as well. If you look at the story of the day and how those yields are behaving, it'll really shed some light into which direction the euro may go. That's in terms of the downgrade in Italy today. Moving forward to October, will S&P downgrade Italy again? They usually don't downgrade just once. Usually it's the first of many. Now, this takes us back to the Greek debt crisis, or the possibility of default. Today, and FX Street, I actually put together an article that should be on the FX Street website. It ties together with Germany. If there's a stimulus plan that will be created to prevent Greece from defaulting, where's a lot of that capital going to come from? It'll come from the strong countries like Germany. Well, how strong is Germany's economy? We would expect it to be quite strong. We would hope it to be quite strong. Germany and then France, in that order, are the stronger economies there. Well, earlier today, the numbers were released. This is on Bloomberg again. German investor confidence fell to the lowest in more than 2.5 years in September, as Europe's debt crisis and the global slowdown damped the outlook for growth. The ZOO Center for European Economic Research in Mannheim, that's the ZOO. It's an index of investor and analyst expectations, and they aim to predict development 6 months in advance. It's a medium-term forecast. Declined to minus 43.3 from minus 37.6 in August. Point being, that's the lowest since December of 2008 and below estimates. That's really bad news. Now, if we're hoping that Greece will have some sort of stimulus package, a lot of that capital is going to come from Germany. If Germany's investor confidence number comes out less than expected, that's not so good. If the source of the capital that we're expecting to get comes from Germany, that's not so good. Great question. How is this information relevant in terms of the Forex trade? Well, specifically in terms of Greece, we talk about the euro currency. Well, there's two issues. First of all, the euro currency. This pertains to the direction of the euro. If Greece is allowed to default, and it's an unexpected default, and it occurs while Greece is still part of the European economy, and if Germany is really, kind of required to absorb a lot of that risk, that's not good for the euro. I think the euro could see much lower lows. And it's not to say the euro hasn't gone down a lot already. We could see certainly much lower lows than that. If Greece is taken out of the euro currency before the default, then that's actually a positive because you're taking away a lot of the liability. But more in terms of the big picture, we know the foreign exchange market moves under the general themes of fear and greed, optimism and pessimism. When there's optimism out there, when stocks go up, we tend to buy those currencies that have the anticipation of higher interest rates in the near-term future, or at least the anticipation that things will get better. So we look to the Aussie, the Kiwi, and maybe, the British pound, if we expect the Bank of England will raise interest rates in the near-term future. Excuse me, we would buy those currencies and we'd sell short the currencies with the low yields that we don't think they're going to raise interest rates soon, like the dollar or the yen. In other words, if I think things are going to get better, I would buy the Aussie yen, Kiwi yen, Aussie dollar, Kiwi yen, or Kiwi dollar, etc. If I think things are going to be bad, if I think that Greece will default and the next step after that will be maybe Italy or Portugal or Spain or Ireland, that could lead to not only negativity in terms of the euro, but in a broad base across the foreign exchange market. What's really scary about the implications of Greece is we say, well, I'm in the U.S. The U.S. doesn't really have a very close trading relationship with Greece. After all, how much Greek investments do I have? I own U.S. stocks. But the fact of the matter is, if Greece defaults, how many European banks, really big banks, like Deutsche Bank in Germany or Societe Generale in France, how much of their investments are in Greece. And we don't know because the banks do not like to share their cards. Deutsche Bank doesn't really want to tell everyone how much their exposure is to Greece. What if Deutsche Bank has a really large exposure to Greece and Greece defaults? That could really hurt Deutsche Bank. I don't think they're going to go under. They're a huge bank, but that might not be good. Well, if that's not good for Deutsche Bank, if the stock goes down, how much investment does Citibank have in Deutsche Bank? Bank of America, which, a lot of people say they're on their last leg. They just laid off like 30,000 employees. What if Bank of America has a lot of Deutsche Bank stock? So you could see how this debt contagion crisis through the banks goes from Greece to the rest of the Eurozone, and from the rest of the Eurozone to the U.S., and from there it could go everywhere. And go back to Solomon, in terms of your question, it's a great question. How does this, pertain to the foreign exchange market? It's the foreign exchange market. Someone asked me recently, what's the correlation? What's the relationship between the forex market and the stock market? When the Dow Jones Industrial Average in the U.S. goes up, what currency pairs should go up? And the answer is always different because the Dow goes up based on the story of the day, just as the foreign exchange market goes up or down based on the story of the day. Lately, the story is Greece and the debt contagion crisis in Europe. And the U.S., believe me, we have our own issues as well. But the stock market has been weak. The Dow Jones Industrial Average yesterday was weak. Why? Because the German DAX, the French CAC 40, and the Dow Jones Stock 50 Index, that's the overall European index, the equivalent of the Dow, but in Europe, those are down because of European banks. And when the European banks went down, that dragged the U.S. banks down, J.P. Morgan, Bank of America, et cetera. I think J.P. Morgan was down another 3% yesterday. That drove down the stock market. I mean, if you look at the Dow Jones Industrial Average, 30 of the stocks, a couple of them are banks. Bank of America, J.P. Morgan, I think American Express is in the Dow holding as well. That's 10% of the Dow are banks. So you look at the story of the day. The story of the day happens to be Greece and how it connects to the banks, and that in turn we can relate that to the stock market. Tomorrow might be a different story. European markets may have, shown some weakness earlier today based on the ZOO number. Now the ZOO number doesn't have a direct impact to the stock market in the U.S., but through the banks it may. Question is, do you think the euro has a future? It's a great question. I think so. I think there's a possibility the euro of the future may not necessarily resemble the euro that we know now. I think that, I really don't know. I mean, I don't want to be one of those, those people that goes out there and at the bottom of the chart say, no, I think the euro is going to go down, because it already has been going down. I think we need to see some real change, and I don't think we've seen that change yet, a real fiscal change. Or we need to see that washout day where the euro goes down so much, we say the worst is priced into it. Does not a lower euro is good for exporters? It is. What's the percentage? Does anybody know? What's the percentage of we look at Germany. Yeah, it's a big export-driven country, export-driven economy. How much do exporters contribute to France's economy? It is good for the exporters. It's actually a great comment because it's a great point, because maybe as the euro is going down, that will actually be the savior of the economy. That the fact the euro is getting so cheap, that will improve the exporters. We know the Aussie's been so strong and the Kiwi's been so strong historically, that's hurt the exporters. So it's a careful balancing act. Things are good, the currency goes up, but as the currency goes up, the exporters start to suffer, and then the currency comes down. Question is, so if a country defaults, does that mean they won't pay their debt? Essentially, yes. It's a little bit of a complicated issue, but yeah, I mean, there's Greece issued a number of bonds. Think of it like, the U.S. Treasury bonds, and the bonds are basically promises by the country that, we're in the case of Greece, we're going to pay, what did I say the Greek bonds are paying? 23-something%, 22%. If they default, basically Greece says, okay, everyone that bought the bonds, well, we're not only not going to pay you the interest, you don't get your principal back either. The same way that if you were to invest in corporate bonds in the stock, in a corporation, you're not going to get your principal back either. That's the risk. What happens to all those banks that own those bonds? That's not good. That's not good for the balance sheets. I have so much. I love the questions, by the way. Keep it up. Keep it coming. But this is not going to go away. I think these are the stories that we're going to talk about coming into October. And by the way, for the market historians out there, I'm sure you remember October is not necessarily a very kind month for stock markets. So those really big crashes that have occurred in the past, 1929, 87, 2008, those happened in October. Not to say that, look, I think that we see lower prices in stocks in October because there's a lot of uncertainty out there. But, I've been wrong in the past. In the U.S., we have our own issues. We have this debt ceiling that we have to pay for. And we have an election cycle coming up, which makes it all the more difficult to come to a consensus. And on top of that, we have the President Obama just announced this jobs bill, which adds another, 4.7, I think it's another 4.7 billion, is a billion, I think, for another $4.7 billion to the debt ceiling. And he says, don't worry, the super committee is going to find a way to pay for it. Well, the super committee is made up of Democrats and Republicans that are not going to forget, the party lines, especially coming closer to the election cycle. And they're going to really argue as we get closer to the deadline. And, of course, it's important that we have a jobs bill, and it's important that we have some sort of measure that's going to, trying to fix the economy. But where are we going to get the money from? And that's really, really difficult. And on top of that, we have the Federal Reserve. Now, in the next couple of days, we have the FOMC, Federal Reserve, Ben Bernanke, chairman. It's going to announce interest rate decision. Everyone expects him to keep rates unchanged as expected. But if you remember last month, remember that really big event? It was the Fed Symposium in Jackson Hole, Wyoming. And some traders, because last year, that's when quantitative easing 2, QE2 was announced, a lot of us were expecting the Fed to announce QE3 during this symposium last month in Jackson Hole, Wyoming. It was not the case, but what they did say was that, wait until our next Fed meeting, because we're going to have a special Fed meeting. It's going to be 2 days, not one. And we're going to further discuss, and they really didn't give us any details at all. It's actually kind of a disappointment. They didn't give us any details at all in Jackson Hole, Wyoming. But they said, don't worry, wait until September. There's a Federal Reserve meeting. We're going to announce our interest rate decision. And we're going to talk about, I believe the wording was further tools that the Federal Reserve can use in terms of monetary policy. But furthermore, and this is actually not from Jackson Hole, but a little bit later on, Ben Bernanke, the chairman of the Fed, he had a speech in Minneapolis, and he said, and he reiterated the fact that, look, the Fed is mandated by Congress, that they're only allowed, in terms of monetary policy, they're only allowed to do a couple things. They can't really change tax code. They can't change spending. All they can really, and that's fiscal policy, all they can really control is monetary policy. And they have two basic goals. Price stability, which is inflation. Inflation goes up, raise interest rates. Inflation goes down, lower interest rates. And also price stability and create an environment that is conducive for growth, meaning creating jobs. But the only thing the Federal Reserve can really do is raise or lower interest rates. That's basically it. And the Keynesian model, John Maynard Keynes, that's basically the economist that the Federal Reserve is modeled after. And Ben Bernanke, from what I understand, is a pretty big fan of Keynes, of Keynesian theory, is that they say that the pure theory, not to get too much into this, but the pure Keynesian theory states that the Federal Reserve should raise and lower interest rates to smooth out the extremes. The economy is really, really strong. Well, to prevent a crash, the Federal Reserve will raise interest rates to slow the economy down gradually so we don't hit these huge spikes to the upside. And when the economy is slowing, in order to prevent a really big crash, the Federal Reserve reduces interest rates, lower interest rates to encourage spending, to encourage jobs, to discourage people from keeping money in their savings account out of fear, to discourage people buying bonds. That's basically it. The quantitative easing 1, quantitative easing 2, that really is, I think, in my opinion, a real stretch. That's about as far as the Federal Reserve is really supposed to go. We're going to find out what further tools that Ben Bernanke was talking about today and tomorrow during the Federal Reserve meeting. I really can't imagine that there's much left. I mean, just buying additional bonds, that in and of itself is a stretch to what they're really allowed to do. There's not a lot else. My point being is, I don't think the Federal Reserve is going to announce anything that is going to be any significant. It's going to have any kind of significance at all. What are they going to say? We're going to buy long-term bonds, short-term bonds. There's not really a lot they can do. They're not going to come out and say, you know what, we're cutting the corporate tax rate down to 0, and we're going to issue a tax holiday so all that offshore capital owned by U.S. companies can come back into the U.S. and it'll really stimulate the economy. Federal Reserve, mandated by Congress, cannot do that. One final thing about quantitative easing, by the way. I heard an economist talking about this recently in Bloomberg. It's actually really quite interesting. Quantitative easing 2, QE2, was where the Federal Reserve bought $600 billion worth of long-term bonds. Now, why did they do that? Because they want to fight deflation. Deflation is when prices go down. When you go to the store and the price of a computer goes down, the price of an airline ticket goes down, the prices go down, it's not a good sign. It means a company has to cut prices because customers aren't coming into the store. That's deflation. Well, in order to encourage spending, the Federal Reserve has to, what they'll do is they buy bonds. When you buy the bonds, the price of the bond goes up, remember, but the yield goes down. Now, let's say I have $1 million to invest. I'm not going to put into a savings account because I'm not going to get any interest at all. I'm probably even going to lose a little bit of money against inflation if I keep it in a savings account. Well, could I put it in bonds? Well, the 10-year bond is paying less than 2%. A couple of months ago, the 10-year bond was paying 3.5%, almost 4%. So I'm not going to buy bonds. I want to buy stocks because stocks, given the risk, offer higher yield. I could buy AT&T stock right now, and it pays a 6% dividend. I could buy a U.S. 10-year Treasury bond that pays less than 2%. I could keep my money in a savings account. I'm going to get basically almost 0%. So that's why the Federal Reserve buys bonds. As the price goes up of the bonds, the yield goes down. It discourages investors from buying bonds. It encourages them to take the risk because there's no other yield out there. But there's something called, what's the expression, unforeseen consequences? That's not it. There's an expression that economists talk about a lot, the unintended consequences. Think about this. When I put my money in the savings account, I'm basically getting the same amount as the 2-year bond. I'm reading right now in Bloomberg, the 2-year bond yield is 0.16%. That's basically the yield that the interest I'm getting in a savings account. It's basically nothing. How does a bank make money? They pay me they pay me interest for my savings. They'll take my savings and reinvest it in something that's really, really safe, but that's going to pay them a higher yield. In other words, they're going to invest in the 10-year bond. The 10-year bond right now is 1.95. The 2-year bond is 0.16. I'll actually type this in. Okay. So the 10-year bond pays 1.95%. The 2-year is 0.16. What's the difference between the two? 1.95 minus 1.16 is 1.79%, I believe. That's the spread. That's the 2-year spread, which is 1.95. Tell me if I'm doing my math wrong, by the way. It's 1.79%. That is the profit margin that the bank makes. Bank of America, I deposit my money into their account. They pay me basically a 2-year bond yield, 0.16%. They take my money, they invest it into the 10-year bond, and they get 1.95%. They keep the difference. That's the profit margin. They're making 1.79% on every dollar. But remember back in the day, 2-3 months ago, when the 10-year bond was 3.5, almost 4%, those profit margins were a lot bigger. Is it any surprise that the banks are in so much trouble right now? Forget about the housing market and the credit default swaps and all the other issues that are affecting the banks. The simple, most basic operations of the banks, the most simple way that the banks make money, they're not making money. Put yourself in the shoes of a banker. How are they going to make money? That's the reason why, and I think that's why, corporate earnings for the banks are not going to be good for so long. That is one of the unintended consequences of quantitative easing. They bought bonds in order to encourage investors to spend, to buy stocks, to invest in companies, to make bonds, which are, by the way, safe haven, look really, really unattractive. But the unintended consequences is that the bread and butter of the banks, the way the profit margin, they're not making any money at all. Question, what is Fed only can do? Number one, adjust interest rates low to 0. 2, print money. Quantitative easing. 3, what other? As far as I know, and I'm basically paraphrasing, Ben Bernanke, the Fed chairman, spoke about this during his last speech. He made a speech in Minneapolis to economists. And he said very clearly, he says Congress has mandated that the Federal Reserve is only allowed to really, they're very limited. Congress has said that the Federal Reserve cannot do a lot of things. They're only really allowed to adjust interest rates. That's monetary policy. Raising taxes, lowering taxes, spending, etc., that's fiscal policy. That's in the hands of the Congress and the President, the executive branch and the legislative branch. Federal Reserve is not allowed to do that. Federal Reserve has 2 primary goals again. Creating price stability, meaning inflation, and creating an environment that's conducive for jobs. So they print money, sure. They lowered interest rates to 0. They've done that. They promised that they're not going to raise interest rates until 2013. They've done that. They've printed money. They've done that too. But what's the unintended consequences of printing so much money? Well, it's like a stock split. Let's say I own 1,000 shares of Google stock, and there's 10 million shares outstanding. Well, if Google tomorrow says, there's 10 million shares of outstanding stock, that's all the stock floating out there, we're going to issue another 10 million. For my 1,000 shares, they're going to give me another 1,000 shares. So my investment stays the same. But the Federal Reserve, when they print more money, they don't give me more money. They don't give me more dollars, so my dollar retains value. They print more money, so the dollars in my bank account have less buying power. My money's competing against more dollars out there. So the dollar loses value. Against what? Well, the euro, the pound, the yen, etc. And against commodities. That's why commodities have gone up so much. Crude oil, wheat, cotton, soft commodities. What's that one magic commodity that we buy when the dollar loses value? Gold. All-time high, $1,800, $1,900 an ounce. There's a very clear correlation aside from that, among that. So the unintended consequences that the Fed goes out there and prints money in order to buy these bonds. Well, remember, they bought the bonds and that hurt the bank profit margin, but just the simple fact of printing the money has put the U.S. consumer at a disadvantage because now we have to spend more on crude oil, we have to spend more on our imports. I don't want to place the blame entirely in the hands of Washington or the Federal Reserve. I don't necessarily know what I would do. We can look back and say, I would not have done this or I would have done that, because we have the luxury of doing so. But I would ask all of you, what right now, moving forward, September 20th, 2011, forget about the politics. Pretend that, whatever we decide to do, it'll pass. What would you do to fix the U.S. economy, to create jobs? I'll tell you my answer. And it's, I don't mean to create any sort of political debate, pretend that politics doesn't exist. Pretend that it's we have the power to just, do what we think is right. But to answer your question, Jack, that's basically it. The Federal Reserve cannot do very much else aside from monetary policy, and I believe a real stretch of the powers is quantitative easing, printing money, etc. Question is, what are my views on gold? How will quantitative easing 3, if that happens, affect gold? I do not believe quantitative easing will happen because politically it's not very popular right now. And unfortunately, politics, as we get closer to the elections, is it's a big issue. If you ask any American out there, what do you think about quantitative easing? They'll probably tell you, well, I don't think a lot of it because it costs me a lot more to fill my gas tank up. And I know that because the dollar has lost value. And I'll give everyone a chance to answer. We have a few minutes left here. I have some really specific ideas as far as if I was put in charge for one day, what I would do to turn the economy around. But I'll ask you first, what would you do? Would you initiate quantitative easing 3? Would you raise or lower taxes or anything else for that matter? Anything you can do. What's my opinion on gold? I hate to say this and be wrong. I think that in October, if I'm right, that I think that the uncertainty will lead to lower stock prices. I think investors will once again look to gold. I don't necessarily think that gold, however, will go up like it has in the past. We may see higher highs, but I think the best days of gold are behind us. Not necessarily, I don't think that gold will crash either, but when we buy stocks, we get a dividend. Most of the time. We own a share of the company. When you buy bonds, you get interest rates. You get interest. When we put our money into a savings account, we have FDIC insured. As little as it is, we have that insurance. Gold really doesn't have any value aside from the money that we make if the commodity goes up. We're basically, you go out into the ocean, you reach down, you pick up a rock out of the ocean. That's gold. We're buying rocks. They happen to be yellow and they happen to be very precious and they're worth a lot, but rocks don't pay interest. They don't pay dividends. Granted, it's precious and it's viewed as a hedge towards deflation or a falling dollar, I should say. But if you look at the chart of the dollar is not really going down that much anymore after the Swiss National Bank intervened, which is a whole other, can of worms. I think because, and everything is connected, the dollar went down against the yen. The Bank of Japan intervened. They said no more. The strong yen against the weak dollar, $86 yen. We're not going to let it happen because we were hurt enough from the tsunami and the earthquake disaster in Japan last March. If the dollar yen goes down anymore, then it's really going to really hurt our exporters. We're not going to let it happen. Swiss National Bank came out just in the past month. They said, you know what, Euro Swiss, we're not letting the Euro Swiss below 120. Enough is enough. Our exporters are really struggling to breathe. I think those two central banks, not that the central bank can move markets on its own, but I think that might have been a really big catalyst to give the dollar support. I don't know necessarily that the dollar is going to go straight up, but the dollar now has support. If I'm right, then I think gold now has resistance. If you see the dollar make new lows, I think you'll see the gold make new highs. But remember, if I'm right in the assumption that I think that if stock markets go down in October, what currency are we going to buy? Well, we can't really buy the yen as much as we could before because we're nervous with the Bank of Japan intervening. I'm scared to death about buying the Swiss franc because the Swiss National Bank might come against my trade. So what's the other currency out there with really low yields that we could buy as a flight to safety? The dollar. Ironically, if stock markets go down, the dollar could become the new attractive currency to buy if we're selling the euro or the pound or the Oz or the Kiwi. So, if I'm right in my guesstimate, maybe, I don't want to say to sell short gold because we're going to go down a lot, but I think we may start to see a ceiling in gold. I would be really surprised to see gold, some analysts say it's going to go to 2,000, 2,500, 3,000. I doubt that's going to happen. That's my own personal take on the story. Can the Fed spend quantitative easing money in any way they like? It's a great question. I don't know. As far as I know, I mean, I think their ability to spend money is quite limited. They can't. I don't know necessarily they can do anything aside from buying bonds. When the government can't pay our debt, the U.S. dollar will go down again later, then will go up in the future. If that is the case, yes. And that is really the big question mark. And I think if you ask the average American out there, the average whoever, the average trader out there, what's the big issue in the U.S.? The U.S. we're still, we're making money. I mean, there's still corporations out there. Apple Computer, they're still selling iPhones. Things are still good over there. The big issue is the confidence or the lack of confidence in the political spectrum. The big question in my mind is, will the Democrats and Republicans, as we get closer to the elections, be able to come together and agree, okay, you know what? We don't like each other, but we're going to agree to find spending cuts somewhere. How are they going to pay the debt? That's how much is the debt now? 14 point something trillion dollars? That's the $14 trillion question, right? How are they going to pay their debt? And I'll give you my answer, by the way. If I was put in charge for one day, well, of course, there's a lot of waste out there. The old story about the federal government that spends, $1,000 for a hammer and $2,000 for a toilet seat. Well, there's certainly a lot of spending that could be trimmed, a lot of waste out there. And I don't, please, don't, if you don't agree with me for any sort of, political background, it's not meant to, to be a political statement, but just in terms of a dollars and cents point of view, the engine that runs any economy are job creators, small businesses and big businesses. Well, the U.S. has the second highest corporate tax rate in the world, I think. I believe it's the second highest, around 35%. If we want corporations to make money and to basically create jobs, how many people does Apple Computer, employ? A lot. Bank of America just announced recently they're going to lay off 30,000 employees. Those are 30,000 employees that are not going to look for work. Why? Because Bank of America, in part, has 35% corporate tax rates. It's the second highest in the world. I would lower the corporate tax rate. Now, I don't mean to get into the argument about, the millionaires and billionaires out there should have higher taxes or lower taxes. That's too much of a heated, argument. But corporations, if you owned a corporation and you had to pay 35% of your gross profit to taxes, if your gross profit tax rate went from 35% down to 15%, you're keeping more money, you're able to expand and build new factories, especially with the low interest rates. Fantastic. Something else I would do is that a lot of that corporate money that has been sent overseas to hide, to avoid those 35% corporate taxes, create a tax holiday. This is something that's actually proposed by a few people in Congress. Give them a tax holiday. 1 year, all your corporations out there that have a lot of billions of dollars overseas. If you bring the money back right now, you have 1 year. We'll only tax you 5%. Bring the money back in the U.S. Invest it in the U.S. corporations. That's great. Another way, all those dividends that investors get from holding stocks or capital gains, especially short-term capital gains from trading, lower those taxes on the dividends and the capital gains. That's really good for the banks. The economy will not get back without the banks. The banks it's a lifeline for the economy. We need those banks to get back on sure footing, especially because the profit margin, the yield is so low. I have a few more ideas. There's a lot that goes into it. What is a twist? It's a dance created in the 60s, I believe. I'm just joking around. The twist, gosh, they've been talking about it for the past couple of days. Who can tell us? Who can explain it the best? I mean, I've been reading about it a lot. I don't know if I can necessarily explain it very, very well. I mean, the words just escape me right now. How, what it means, what it pertains to in terms of the situation. Is it true that the young Current generation are already in debt and have to support the older generation due to the Fed printing money. Well, yes, and you will see that result in taxes. In order to pay off the debt, they're going to have to raise taxes to do so. It's a tough situation. It's a really tough situation. Operation Twist, it's another big gamble. I don't necessarily agree that it's the right way to go either. I don't think that, again, I mean, not to make any political statement here, but the fact of the matter is, you look at the jobs bill. The jobs bill includes extending unemployment benefits, and I certainly do sympathize with those that do not have jobs. It's really tough out there. But in the dollars and cents in terms of extending the unemployment benefits, I don't think it's going to create jobs. Another part of the jobs bill is to, improve the bridges and the roads and the tunnels and the schools and all that stuff. Listen, if we need it, we need it. But what happens to those 30,000 Bank of America employees? Those, bank managers, they're not going to be able to get a job fixing highways. I don't think they know how. We need to create an environment where former bank employees can find bank jobs, and that those employees that used to fix highways can find jobs fixing highways. And I think that's why the federal government should not be involved in the creating jobs, but rather create an environment where the job creators will create jobs. Let's say, well, it's good because those in the construction industry, if they create a plan to build bridges and roads and tunnels, well, construction is construction, right? But what if I'm a plumber or I lay tiles? There's no plumbing in a bridge. So even though I'm in the construction industry, I can't really get a job if I'm a plumber working on the bridge. Twist is Fed. I really thank you for typing this, by the way. Fed taking money from short-term bonds. And that are coming due and buying longer-term bonds. Is that the question? You are correct. But what does that do? It slipped my mind. Thank you very much for chatting that in. I think it's a bad idea because they're going to buy this long-term bonds. They're going to sell the short-term bonds. But what is that going to do to the bank profit margins? That means that all that money, put yourself in the shoes of a bank executive. The customers come in, they say, I have $1 million, put in my savings account. I say, oh, great, I'll pay you, 2-year bond yields, 0.16%. Now, I got to run the bank. I got to turn around and invest that in longer-term bonds. If they buy the longer-term bonds, the yield is going down. That's going to squeeze the profit margins even more. I think, look, there's unintended consequences with any action. But I think taking into consideration the banks, they're in such a weak position already, I think that we have to look for another solution. I would look to create, again, my solution is to create an environment that's conducive to creating jobs, especially in the sectors that are worst hit, like banking and housing. The final thing I'll say is this, because I really am running short on time. I hate this. I have so many more things to talk about. But the final thing I'll say is this. I heard an analyst, an economist on Bloomberg yesterday saying that, you know what the Federal Reserve should do? They should raise interest rates. Because all of those people out there that maybe could buy a house, what are they saying? Or maybe invest in a company, maybe I'm going to spend money. They'll say, I'm not going to spend money right now. I don't have any confidence in the market. And don't worry, the Federal Reserve told me we're not going to raise interest rates until 2013. Everybody with any kind of money is sitting on the sidelines. If you think that the Federal Reserve is going to raise interest rates tomorrow, that will light the match. That will induce a lot of people, to actually move their money. Unfortunately, I'm really, really out of time. I want to thank you all very much for joining us. Really great show. If you have any questions, you can contact me directly, www.forexfinance.com. Again, I want to thank you very much for joining us. Wish you a great day. All profitable trades. And we look forward to seeing you back soon.